Have you seen it? REITs are up more than 10% over the last 3 months. If you take a look at this chart over here, which is the S-REIT index, you realize it's from 1,000 points to now 1,134 points. This is also a very nice rounded bottom, correct? With April tariff crash as like a beautiful last flush for all the weak hands out there. Then this new bull is formed, and it's also formed with a very strong base. In fact, if we see the 5-year chart, 1,000 points is such a strong base built over many crises. 2023, it seems like there was an anger phase. Wow, rates are still going up. When is the end? People are getting very angry about the whole situation in REITs. REITs are going bankrupt. I keep seeing that in the comments sections. Then 2024, depression phase. Still drop again after a forced rally. I've even seen comments, Josh, it's your fault. I follow you to buy REITs, and right now you see banks are going up, but REITs, we're still in the doldrums. All this was all very evident in the depressing phase. Then 2025, disbelief. Yet another new drop. Yet another new low. So if we pull up this investor psychology chart, you realize that anger was here in 2023. Depression, 2024. Many years of bad news already, right? And last but not least, disbelief in 2025 when a new low was cracked yet again. But as we pass disbelief, we enter a new phase, which is today, hope phase. Sounds like good news, correct? And I'd like to reassure you that it's likely still early. And I have 2 main reasons why also. In today's video, I'll also share with you, if you are new to the entire REIT scene, what to understand. I'll also show you all the latest numbers and all the latest important updates. So if you're curious, continue watching. Hi guys, welcome back. Thank you for sticking with the long intro. First up, let me recap on what are all the biggest REITs into. Let's look at the first classification, which is diversified REITs. They are typically REITs which own offices and retail. Offices are typically very long lease, and even in the office space, there's grade A office, which is top quality offices. CICT is in this space, and the biggest one, they own Plaza Sing, they own Bugis, they also own Raffles City, correct? Which is a hybrid of offices and malls. Then the second name on this list, MPACT, which owns Vivo City and also owns Business Park and also owns Mapletree Business Park. Speaking about CICT also, I don't know if you know, they've recently overtaken Link REIT to be Asia's biggest REIT. So congrats to CICT. And with that, let's go back to the overview. And the next segment will be industrial REITs. Ascendas, which is the second biggest REIT in Singapore, is in this space. You may have been to Science Park. You've seen all their industrial buildings. They also own flatted factories. Another very popular blue chip in this space, Mapletree Logistics Trust. MLT owns assets not just in Singapore, but also in China and many other parts of the world. Then let's move on next to data centers, which was once the hot stuff. Mapletree Industry Trust is in this space, and Keppel DC also. Actually, Ascendas has been gradually moving to acquire more data centers, but it's still a very small segment in Ascendas, so they are rightly in the industrial REITs. NTT REIT, which was recently listed, is not in this list as this is not updated yet. Then up next, retail REIT. Retail means all your malls. The biggest pure retail REIT is Fraser Centrepoint Trust. I've just been to Next. For myself, I go to more to Tiong Bahru Plaza. So Fraser Centrepoint Trust owns the most heartland malls all around Singapore. If you follow this channel, I've always shared that this is one of the easiest spaces to invest because you can go and see how well the mall is doing, correct? We can say everything about e-commerce, but if you go to malls like Next, you realize it's always super crazy crowded. Then up next in commercial, we realize that there's Keppel REIT. Keppel owns Ocean Financial Centre and many grade A offices. The next category is hospitality, which owns hotels. Biggest one is Escort, and I do own some shares of Escort. They own Citadines and they also own Lift at Funan. They are breaking into the co-living space. Next category of REIT is healthcare REIT. Inside here, Parkway Life REIT is the biggest name. Parkway Life REIT is always considered to be essential service because they own hospitals like Gleneagles, correct? So rain or shine, these assets are very stable. So hopefully if you're new to Singapore REITs, this is a quick useful breakdown. Each and every segment sees their own dynamics of supply and demand, so they may not be seeing the same tailwinds and headwinds. If you need to take a quick snapshot, and let's move on to the performance, correct? Because that impacts our investment journey. So I've prepared for you this over here, which is the 3-month performance summary table. what do we see? A lot of green, correct? And there are a few outside this list, it's true. But this list is already the majority of S-REITs. And in this last 3 months, there's been this tailwind of Fed cutting rates. It's not just Fed cutting rates that is impacting REITs, it's the overall sentiment. And therefore, this last 3 months, many REITs have done even better than OCBC and UOB. Right at the very top of this list is Prime US REIT and Lendlease REIT. They've gained more than 20% in the last 3 months. And that's because they are off from a very low bottom. So as always, don't just choose what has performed better in the last 3 months and bet on it. Investing is about guessing what's the future ahead and not just on past performance. If we zoom into the blue chip REITs, I'd like to highlight Suntec REIT, 14.8%. I once used to own Suntec REIT, but I've sold it off to reinvest in other sectors. No regrets. I sold a bit of Mapletree Pan Asia Commercial Trust, MPACT, which has shot up by 14.1%. So I'm happy that the remaining stake is still gaining. I still own a lot of Escort Trust. Happy to see it gain strongly at 8.4% over the last 3 months. And I also own a little bit of CICT, which gained 5.9%. So on and so forth. Look at this table. And what I would like to conclude for everybody is this entire REIT rebound, REIT climb, REIT bull market, whatever you want to call it, is very broad-based. All industries, that's why the entire index has climbed, correct? And on a technical scale, it looks like it's inching to crack this 1,130 once and for all. We see that ceiling, and once it cracks, I'm pretty optimistic we can get to higher points. Leave in the comment sections whether you agree or not. Maybe you're bearish about REITs, I'm okay. Let us know. And if you have learned something, smash the like button so we can reach more investors together and what together as we move towards 2026. Thank you very much, and let's move on to the next chapter, which is 2 big reasons. Why not just on a technical scale? I believe fundamentally REITs are very, very bullish. The first reason is finance costs is really dropping. Still not yet seen across all, but some of the blue chip ones are already seeing positive impact. Let's look firstly at MPACT. You realize that previously it was at 3.54, then it dropped to 3.51%, and in the latest quarter, only 3.32%. Every percentage drop means less interest cost, correct? Which means also more net rent profit that can be paid to you as an investor. It's not just MPACT, let's move on to our biggest REIT, CICT. DPU has inched up, which is good, and it's largely driven by 2 factors. One, positive yielding acquisitions, and the second is also a lower cost of debt. In fact, recently, CICT has raised new monies in a 7-year bond that pays only 2.25%. I would think that cost could drop a bit further, which means further tailwind. And recapping again, REITs, they own real estate. And when you own real estate, you borrow money to own it. You don't put full cash. It's like us buying an investment property that we'll put 60% money in and we'll borrow 40%. When the interest cost is high, we pay more. But if the interest cost drops, like what you see even now in residential property, you realize that you can save money. And REITs, that means you save on costs, you can pay out more of profits. I believe also in this dropping interest environment, there will be more mega acquisitions of real estate. Similar to what has happened back before COVID, that was when REITs were using low cost of debt to go and acquire properties and grow their DPU. I think that wave is still very early. And not just that, I think there could be even more M&A within the REIT space. One REIT buying another REIT using debt, because right now, cost of debt is dropping. If you can show investors that you can grow DPU, they would vote and support it. So these are things I'm forecasting positively in the REIT space. And let's move on to the second reason, which is REIT demand is really strong on the ground right now. How can we prove it? Let's look at some successful IPO recently, which is in NTT data centers and also in Centurion accommodation. Both of these REIT IPOs were oversubscribed, and NTT now is past its IPO price of $1. Centurion accommodation, even better because its IPO price was only 88 cents. This is very different from so many years of REITs which have seen their price drop sharply after IPO. And I believe that the reason why demand is so strong is because guaranteed rates in Singapore have fallen to less than 2% already. If you look in terms of T-bills, 1.44%. But if you look in terms of dividend yields for all these blue chip REITs and every REIT that's IPOing right now, you will get significantly higher. That is the risk premium, and right now it's very favorable. If you're looking to understand the dividend yield right now for all the blue chip REITs, I found this summary table. So Parkway Life REIT, 3.5%. And if you move up the list, you can even find 6.3% from Escort and Mapletree Industrial Trust. That's a full 4-5% again over risk-free rate. And we have to still factor in just now what I mentioned, correct? That as interest cost comes down, they are able to save money and pay more dividends, which means the dividend per unit could climb. So if you're keen to understand a bit more, take a quick snapshot. And just to draw some attention also, this summary table also shows price to book value. If it's at 1, it means that you're buying at the book value. If it's at less than 1, you're buying at a discount. That's a simple matrix, but more importantly, usually for advanced analysis, we look in terms of its historical price to book. From that front, many REITs are still below its historical price to book ratio. Mapletree Industrial Trust, for example, at 1.2 plus times seems expensive, but historically it was 1.5 to 1.7 times. So I still see it as a discount. So with that clear, I'd like to circle back to a question which I've seen in the comment sections recently. Any REITs? Hi Josh, FD rates are dropping. Will dividends drop too? Say previously 5.4% dividend yield, now 3%. My answer is dividends is not like bank interest, like OCBC 360, UOB one account which they've been cutting interest rates all the time. That is bank interest, but dividends is from profits. And I've shared today, profits are likely going to grow because of favorable interest environment. And when profits grow, dividend actually grows. But if we think in terms of dividend yield, which is dividend over price, as just now shared, 3.5 to 6.3% for many blue chip REITs in Singapore, that will likely drop in the future. And it's not dropping because the numerator dividends is dropping. It is because the denominator, the price, will be increasing. Dividends climb a bit, but price climbs a lot. That's my guess. That's my hope. And if price continues to climb, that is good news for REIT investors, correct? So think about it. I'm here to highlight opportunity for consideration. And if you'd like to learn more, check out this previous video I have, which is on a REIT that I feel might be the best performing in the year ahead. Check it out and I'll see you there too. Take care as always. Goodbye.